Hello, Mr. Alvarado.
Hello, Mr. Melara.
How are you?
Very good. How are you?
Fine. Well, I came here because I'm interested in investing in your business. So I was hoping you could give me more information about your
Oh,
business.
of course. You should totally invest in this business. It certainly will be profitable. You just need to know, I'm guessing, the gross profit margin and the net profit margin,
Yes,
right?
I want to know all your ratios so I can tell if it is worth to invest in your business.
Okay, so first, my gross profit margin. Right now, lately, I've been having troubles with my direct labor costs. So really, my gross profit margin hasn't been that great lately. But I will make sure that I will raise it by raising revenue. That I will be able to increase the selling price of those goods that are price inelastic, and decrease the selling price on those goods that are price elastic. So if you want more information, I can actually show you right now in the figures.
Please do.
Okay. Okay, so right now here it's my gross profit margin. My sales revenue in this moment it's equal to 1,500, while my gross profit in this moment is equal to 500. And of course, we all know the formula, right, for gross profit margin, which is the gross profit over the sales revenue times 100. And of course, we can do this in our heads. This will be equal to 33.3%. And as you can see, my figure right now, it's not the best one, but I already explained you why. But I will assure you, Mr. Melara, that if you invest in this business in future, you will see high profitability.
Okay, so I'll trust you. I'll take the risk, but I want to see higher margins.
It's a given. You will certainly see higher figures. Just invest in this business. It's the best that you will ever invest in.
Okay, you got
Okay.
yourself a deal.
Okay. See ya, Mr. Melara.
Mr. Alvarado,
Hello, Mr. Mel.
how you doing?
Very good. Please take a seat.
Thank you, thank you. So, you must be wondering why I am here.
Yes, one of my favorite shareholders. What are you doing here?
Well, I'm concerned about the liquidity of the business. It seems that we are taking too much credit and we're not having enough cash. So, I want to know what's happening with the capital.
Well, right now we have a lot of frozen assets. If you want, I can show you the figures.
Please show me.
Okay, so Mr. Mel, you are worried about our liquidity. Right now, I will explain you one of our liquidity ratios, which is the current ratio. And of course, we all know the formula for that, right? It's current assets over current liabilities. And in this case, our figures show that it's 97 over 45, which of course we can do that in our heads. It's equals to 2.15. Now, what does this mean? It means, Mr. Mel, that for every $1 that we have 2.15 in liquid assets. This means that if we were to downsize our business, then we will immediately make cash. Well, not immediately, but this is actually a desirable figure. So really, Mr. Mel, there's no real cause of concern. You just don't worry. We will try to make long-term loans in order to improve our liquidity ratio in the future. Right now, we need an overdraft in order to cover some direct costs of labor. What do you think?
Well, it's better than I expected. Now I realize that we're in a pretty good position in terms of our liquidity, so I can sleep calm now.
course, you know, Mr. Mill, and you should definitely clip your shares because they're going to increase value in no time. You will just see.
Okay, thank you, Mr. Alvarado.
See you, Mr. Mill.
See you next time.
Mr. Ara, you go for manager me, Josue.
Yes, please take a seat. So, Mr. Josue, you must be wondering why I asked you to come here today.
Yes, I've been doing a great job.
Well, we have an issue.
What's the issue, Mr. Ara?
Look, I was checking out our ratios and I noticed that we're not being as efficient as we should be because our ratio of return on capital employed is too low.
I see. Return of capital employed.
Yes, I'll show you what I mean.
Okay.
So you'll see, Mr. Josue, this year we got a net profit before tax of 250. You understand?
Yes.
And a total of net capital employed of 1,552.
Yes.
Okay, if we carry out the formula, easy peasy, we should get a 16% on our capital employed.
I see, Mr. Milara.
So, Mr. Josue, what do you propose to improve this ratio?
Well, Mr. Ara, first off, I need to tell you that this percentage that you just gave me is actually quite worrying. As you may know, the return of capital employed figure shows the profit as a percentage of the capital used to generate it. The higher the return of capital employed figure, the better it is for the business.
Yes, I understand.
Because we operate in the secondary sector as manufacturers in the textile industry, our benchmark of return of capital employed should be at least 20%. And if you can clearly see, it's way below that.
Yes.
Therefore, I suggest, what I'm going to suggest you right now, actually before I do this suggestion, I need to ask you, did you do any type of deposit in a bank account where the interest rate is actually higher than this percentage?
No, I don't think so.
Okay, but I just need to tell you that if bank deposits in general, we probably carry less risk compared with other investment projects. Hence, why the return of capital employed must be high enough to create an incentive for investors to be part with their money, or otherwise investors will stop coming here, Mr. Ara, and they will no longer invest in our t-shirt happy business. That's why many people regard the return of capital employed as the single most important financial ratio, since it measures how well a firm is able to generate profit from its sources of funds. That is why this is a key ratio or a primary ratio, Mr. Ara. So I'm really concerned that this business is right now not operating at its maximum efficiency. So, Mr. Ara, because the nature of our business, what we actually need right now in order to increase our return of capital employed is an investment in a more variety of products. Because according to these figures, we actually need more. And because we have a lot of competitors right now, there are a lot of more factors to consider than just a mere number. Therefore, it will be good if we carry out a full cash flow and we actually see how much will our business be worth in the future. So therefore we will need a discount rate table, and for now I think that that's about it.
Okay, so you think that By doing this, we can improve our ratio of capital employed.
Well, we will be able to see more evidence, and therefore we will be able to know what a real problem is in the business, because right now a lot of things could be in the way, especially because we operate in an industry which is heavily full with competitors.
Okay, so I see. So we'll do what you're telling me and we'll keep track of our progress. Thank you for coming.
Thank you, Mr. Ara. So, Mr. Raul, right?
Yes, you must be Mr. Swift.
Yes, I'm here because I'm a potential shareholder.
So, how can I help you?
Well, I would like to know that if I were to buy shares out of this business, how much would my earnings per share would be?
It's simple. Let me show you. So, to find out the amount earnings per share, we have to carry out a formula. So, you'll see. We have our net profit after tax of an amount of 190,000, right? So,
And you have 1 million shares available in the market.
yes, that's right. So you divide 190 by 1 million.
Oh, that's really easy.
Yes.
You can do it in your head, 0.19.
Yes, that's right. So what does this mean? That for every share that you buy, you will get in return 0.19 cents.
Wow. Oh, wow, this looks very promising. You know what, Mr. Raul? I will buy 200,000 shares.
Perfect. Now you officially become part of our company. Congratulations.
Yes, I'm happy to become a shareholder.
Mr. Alvarado,
Mr. Investor,
how are you?
very good. So you must be wondering why I called you.
Yes, I'm curious.
You are the American Bank,
Yes, we are.
and I'm Meat Inc. I want you to lend me some money in order for me to buy a lot of cow beef.
Interesting.
Let me show you.
Okay.
You will see, Mr. Investor, Mr. Creditor, actually, that in fact we are not a highly geared business, which means that we are not a risky business due to our large amount of debts, which actually we don't have. And if you actually check our loan capital and our capital employed, you will actually see that we are not at any point in risk of the interest rates going up, because our loan capital is only 350 and our capital employed is 1,552. You can do the math. It's actually pretty simple. Then you multiply that by 100. That would be equal to 22.6%. And you know why that is a good thing, right?
Yes, you know, I think you're trustworthy and I think we'll get our money back.
Yes, I'm pretty sure you will get your money back. So lend me that $1 million for my cow beef.
Okay, you got yourself a deal.
Okay. Thank you, Mr. Creditor.